Josh asks, how do I determine, and this is a great question that comes up often, how do I determine the valuation of my company? How does one determine the value of a company? Let's pretend this is a startup company in the first year.
Well, I think that the answer varies depending on why you're valuing it and what you're looking for.
Yeah.
So there are traditional investment banker methodologies like discounted cash flow, but most startups don't have any cash flowing,
Sure.
so that doesn't really work.
Discounted burn rate?
Yeah.
How much are we burning? Oh, the more you burn, the more you're worth.
So, if you are looking at it from an option granting perspective, you will go out and get an independent valuation. It's called a 409A valuation based on a IRS tax code section.
These are like bankers do this, right? Like there's some like accounting firms that do a 409A valuation, and we have to do this because of the stock market crashing last time, or people are very attuned to this, it seems, making sure the 409A is correct.
Enron, actually.
Enron?
Yeah.
It's
all about senior executives that deferred their compensation so they wouldn't be taxed in the current taxable year. So they pushed it out into the future year over year over year to avoid paying taxes. And the IRS wrote regulations that cast a broad net to avoid that, which inadvertently picked up stock option grants. So in order to avoid having really, really nasty tax consequences when you're granting options to employees or consultants or other service providers, you really need to make sure that you have a 409A valuation in place.
And the lower it is, the valuation, compared to what the preferred shares sold for, typically people get in common, that's better for the employees, because that's the price they're paying for the stock, and the gain they would get is what they sell the stock for.
That's right. And so it's interesting from a founder's perspective to, you almost want that to be lower because it allows you to more easily recruit, and people will be happy about a cheap exercise price for their options. Whereas when you're going to raise money, you want your valuation to be as high as possible. So they're a little bit counter to each other. And in that context, the investors will set the valuation. You should be thoughtful about what percentage of your company you're willing to sell for what amount of funds.
So this gets to the second stage, which is I'm not giving options to employees or co-founders. I'm giving options. I'm selling shares to an outside investor.
Right.
Mm-hmm. In the market today, in 2015, going into 2016, when we're taping this right before the holidays, what do people? How do people typically figure out the valuation? Do they look for the angel investors to put a value on it? Do they suggest it themselves? Does the angel suggest it? How does it typically work today?
I find that it's usually the investor that sets it. Mm-hmm. But again, I think that the founders and entrepreneurs should have an expectation. You don't want to go in blindly not understanding how this is going to impact the capitalization and dilute you. But it's kind of the buyer who will set the terms. Mm-hmm. And for those guys, it will vary quite widely. They'll look at comps, what are other similarly situated companies selling stock for. And then, frankly, I think oftentimes they'll back into a valuation. They'll say, I have X dollars that I'm willing to invest, and I want to own Y percentage of the company post-closing, and so we can back into the valuation pre-money.
How does this negotiation typically go down, Rachel? Like if people can't figure out, the expectations, like we see so many of these companies coming out of some incubators with very high expectations because of previous high valuations. It seems to have tempered itself of late, where things have come back down.
That's right. I mean, I think we've all watched, especially some of the public displays of people thinking that the market's overvalued many of the private companies. So I think that's kind of helping level set things. I agree with Todd entirely, which is it is absolutely a negotiation. And I think for better or for worse, a lot of it depends on the players in the negotiation, right? If you're a first-time entrepreneur who has no real track record and may not come from the best breed of whatever it was, like it may be harder for you to drive a high valuation than someone who's on their second or third startup and is just, everyone's clamoring to put money to work there.
So if there's a marketplace and there's competition for the deal, the value is going to go up, obviously.
Absolutely. And I think the other point, which is to underscore, it's not really on you to set your own valuation. And in fact, it is on you as a founder to go out and be doing a market check, right? You should talk to a handful of investors and kind of get a level setting to say, if I need to raise $5 million, how much of the company are you willing to buy and am I willing to give up? And you should do that serially so you actually understand what the true, demand curve looks like, because you may just be, frankly, wildly uncertain about the way your company stacks up, everyone believes their company is worth billions of dollars until they go out and market check it, and then they have a little bit of a reality set. And I think it's important to do that because it is, at the end of the day, a series of negotiations where you have to land on something that both investor and founder are comfortable with, or no one's happy.
Yeah, the way I typically handle today is I ask them what they're looking for, what would be their ideal situation. They tell me, and then I say, explain to me based on that valuation how you are going to return 100 times my investment, because that's my goal, is to have 100x return, or at least in every company to have the chance at 100x return. So if somebody asks for a $10 million valuation, I say, okay, well, explain to me how this business becomes a $1 billion business. How much top line revenue, what's your bottom line have to be to hit that? How would you? And it's amazing how many haven't gone through that exercise.
Right.
And a lot of times I ask people, do they have a lead and who the lead is? And they don't have a lead. What are your thoughts around leaderless companies in the last couple of years, where we have, some people call them party rounds, where there's no board, no individual investor is more than 10% of the round, and there's basically no governance. I know we had, I was an investor in a company called Circa, and Matt, who ran the company, just gave a talk, and he said one of the things he regrets most was that they didn't have a really big, they had no board, and they thought that was cool until when things hit the fan, there was really nobody who cared enough to really fight to keep the company going. They didn't really have a support structure.
Yeah, I mean, I think you hit the key point. I mean, there's some element of leadership that's necessary. And again, a party round may be perfect for some companies, and it might be perfect for some seasoned entrepreneurs who sort of know what they're doing. But I think one of the biggest value adds of a lead, right, regardless if it's an angel lead or a typical firm lead, is that they truly can add perspective and value to the building of a business, right? And they have ownership in it, because usually, something greater than 10% in a round, I mean, that's going to give them some skin in the game, and they are going to help you through the hurdles, and they are going to help you navigate. Again, this goes back to picking the right partner. So I think there's a time and a place for the group rounds, but I honestly think that most companies really benefit from some leadership, some governance, some
When should they have a board, Rachel? When do you suggest people start to put a board in place with outside directors or investors, not just the founders?
So, I mean, I think Series A for sure. Again, what Series A means is also a moving target these days.
A couple of $1 million.
Couple $1 million, absolutely. Yeah. When you've got real money that you need to manage, and you're starting to grow beyond just your core founding team. Because again, I think it's better not to be in your own echo chamber, right? If Todd and I are co-founders and all we're doing is listening to each other, that's probably not going to produce as good a result as if we had a third person to just be a sounding board. So I think, a couple $1 million, Series A for sure.
What about doing it when you have a convertible, or you're just on your seed or angel round? Because I've started to think and advise my incubator companies to start boards earlier, proactively, and to just get an independent or somebody they really love on that board, and to just start holding, a board meeting every other month, even if it's very light, not, super heavy hitting, but just to get themselves into some sort of cadence around governance. What do you think of that idea that I've been suggesting?
I think it's a really good idea. And I think the reason that you even have to propose that to entrepreneurs is that there has been this trend towards leanness for leanness sake, and having very pared down governance and total control in the founders, which in certain circumstances is appropriate and it's just fine. But there's an awful lot of value that you can get out of mentors and board members and people that will help you. And I think that we should look at this whole governance ecosystem as something that could and should be beneficial to the founders, and that they can help them grow and help them grow their company. I mean, it's a hard thing that these people are doing. And I think we've been taught that the sole founder, that's the way to go. Maintain control as long as you can, and I think that's sometimes to the detriment of bringing in people that can be really supportive and helpful. So I don't think there's a one-size-fits-all solution, but I think doing it earlier could be really good for a lot of companies.
I'm going to mandate it to my incubator companies, because you know what? And not that I'm on the board or I have any seed, just that they have a board of like 3 seats, 1 independent, the 2 founders, and they just start doing a board meeting, so they have something to look forward to every 60 days to sort of become a waypoint in the history of the company.
And the accountability piece that you mentioned, I think, is a really important one as well, because if they don't have that kind of cadence and the thoughtfulness of, I'm presenting to someone else and I need to make sure that I've got everything in order and that I'm thinking clearly, if that isn't part of the regular discipline, it's going to be very difficult to flip on a dime once they've taken in a big check.
Yeah. It's fascinating how many companies there are today what do you think of the number of companies there are in the ecosystem versus the number of investors? Your business has gotten really, I know you guys are super busy because we work on things together and you're slammed all the time. I'm slammed all the time. Is this sustainable, this number of companies? Because we've all been in this business for a long time. I've never seen it this active, but I've also never seen this much revenue coming into certain companies. What's your take on it, just on a personal level, how active Silicon Valley is in 2015 going into 2016?
I think there will be a lot of companies that fail over the next few years, and I don't think it will be awful. I think there are companies that aren't standalone businesses that they will get bought, or people realize that and decide they want to go do something else. But I think they will have been trained well, and it'll be a great experience. So I do think that we will see a bit of a slowdown, but I think that at the core, there are more really amazing companies being developed today. And I think those companies are going to go on to do really great things. So I see it as a natural weeding out of companies that really weren't meant to be long-term standalone businesses. And I think that'll be good ultimately for the ecosystem.
Bridget, what are your thoughts on the expansive field we're seeing?
I think we have to remember part of the reason that that's happening is just because it's the cost of starting a company is so much lower than it has ever been historically. And so by definition, there's so many more market entrants. And I agree that just by definition, that doesn't mean for every new company, there's a new investor that enters the space. And as a result, not all of those companies are going to grow up to be successful. I think the good news, and Todd highlighted this, is that many of these are developing features that other companies will be interested in. They'll be nice little tuck-ins. They'll find their way to maybe merge with each other. But there's so much innovation, and inspiringly so. I think that trend will continue. But again, I think we will definitely see companies fail. And I don't think that means that we won't have another onslaught of tons of companies in 2016, but I think we just have to be mindful that that's just going maybe our new norm, right? Lots of companies, lots of failures, and still some great pieces that get pulled from the rubble.
I think getting used to small failures and gigantic wins is going to be what we're all going to have to consider the new norm. You might on a name basis have 7, 8, or 9 out of 10 as an angel investor fail. But boy, when they do hit, you're going to start talking about hundreds or thousands of X returns. So it's a very interesting psychological phenomenon to go through. I know for myself, just dealing with so many different companies, investing in 30, 40 a year, you get a lot of phone calls from people who are in a panic and their companies are going to shut down. And then you don't get the phone calls from the people, like Travis and Marco at Thumbtack and Travis at Uber. Like, they don't need to call me because things are going so well. So you actually wake up thinking, my God, everything's going really poorly, until you actually do, an assessment of the portfolio, an assessment of the winners, and the winners greatly outstrip, the returns of the losers. So it's a very exciting time, isn't it?
Yeah, well, and I think it's highlighted by the different conferences that you do. You have launch, and then you have scale,
right.
And they're different hard things to do, and so different people excel in different areas, and I think you'll see that in the companies as well.
Not everybody makes it to the next conference.
Yeah,
it's basically I made a conference to help my portfolio companies. I literally was like, if 50 people come and talk about just growing them, and I provide the service for them to go and hear 54 speakers talk about growing, I'm trying to really find opportunities for them to learn how the growth occurs. Because people do tend to get caught up in this, what I call the feature death march. They just want to work on the next feature. They never think about the growth. And the bandwidth seems to become a real issue with these venture capitalists. The number of VCs is static. The number of companies is dynamic. We got a real logjam in C to logjam at A, logjam at B. Everything's just a line around the corner to get these rounds done.
Yeah, that's true.
It's going to be a very interesting couple of years. All right, listen, we could talk for hours. So many issues. You guys did a great job of taking complex topics and making them digestible. Thanks to Rachel Proffitt and Todd Carpenter of Wilson Sonsini, WSGR.com, and Wilson Sonsini on Twitter. If you have more questions, you can just tweet them to @TWI Startups. You can follow the show, TWI Startups, on Twitter, on Instagram. You can follow me on Twitter and Instagram. I'm Jason, JASO, and that's my obnoxious way of saying I have premium accounts. It's always fun when you're at a party and people are like, what's your Twitter handle? I'm like, Jason. Yeah. They're like, okay, yeah, Jason _ what? Yeah. No, just Jason. All right, listen, great job, guys, and we'll see you next time on This Week in Startups. Bye-bye.